Hello everyone, and welcome back to another options trading session. Today we'll be talking about options volatility. So come on, join me as we walk through the options trading. Today we'll be looking at the options house trading platform, and we're going to be looking at Walmart. We typically use Walmart for quite a few of our examples because it's a solid bellwether stock and it has some good data to read. So let's go ahead and take a look at the chart section for Walmart. So implied volatility, how does it impact my option? Why would I care about it? Well, if you take a look at the bottom here, you can see that there is the implied volatility, which is what it currently is today, and this was post data. You can see those dates there. And then also the historical, so that matches from last year. So it kind of shows you what it's done in the past so that you can see, is it following its normal trends. The reason this matters is the more that the volatility spikes, so here we are at August 24th, 2015, Walmart stock got to implied volatility of 30. So as that volatility increases, so does the options premiums. That's a great thing if you're a premium owner, meaning you own the call option or the put option. It is a terrible thing if the premium deteriorates as soon as you buy it. So for instance, if you buy an option and it's at, say, a 30 implied volatility, and then it pulls back all the way down to an 18 implied volatility, even if the stock didn't move at all, not only would have time have eroded on that option, but also the implied volatility will come down, which will cause the option premium to come down. So if you bought it at that high implied volatility, it will impact your dollar cost on that option. So what that means is, as a trader, when the implied volatility is high, you don't want to be buying options, you want to be selling options. And we'll talk about that more in some of the further classes that we do. But just remember, for this class, high implied volatility means that we wait. It's not time to buy yet. We wait until that implied volatility comes back to a normalized amount before we start looking to buy an option or not. So Walmart, is it high or low right now? Well, if we look at these kind of low points, we're looking at about 11% implied volatility for the year on the low side, and on the high side we're at 26 to 30 implied volatility. So as long as the option somewhere in between that range, say at the 20 to 18 mark, I think it's probably fine to buy options at the current price. Okay, that sounds great in theory, but can I see an example of how the options volatility changes how the prices are? Absolutely. Let's take a look here. We're going to click on the buy sell option. And again, we're on the Walmart stock. And we're not going to click on buy or sell because that's actually buying regular stocks, but we're going to click on the create spread button. We're going to click on custom spread. And then we're going to delete this buying shares, and we're going to click on add a call. Doesn't really matter what we add. We can add just about anything, and we can have an example of how the vol changes. We're looking at a January 1760 call here, and we're going to click on create order. Now we can click on this analyze button, and it will show us how the vol pricing will change the option spread. So let's look on spectral analysis, and here you can see as the stock option progresses, you can see how much money you can make. So in this case, we have by May 10th, if the underlying stock is at $83 a share, this strategy would have created a gain of 426%. So what happens if the volatility changes? Let's do an increase on the volatility. This would be, we bought it at 1968. Okay, and then let's go back to our example. Not a huge change at that high of a premium. This would be if Walmart got all the way back to $82 a share. But down here in the lower part, you can see how these underlyings turned green, whereas they were red before. Let's go ahead and switch back, and I can show you again. Watch this section right in here. See how that changes? Those options premiums changed the actual curve quite a bit. Now what if the option premium really came in? Let's say it hit 11. See how you would lose money. You'd have to get above that strike price to even start to make money at all. So this is the reason that you have to pay attention to the volatility price as you're buying the options. So it's a win more than it is just what is the stock price and am I ready to buy an option.